Is a housing price crash finally imminent? In fact, month over month, now the median home price fell from $414K to $404K. Stick around because you're going to get a few real surprises. You're also going to get the definitive yes or no answer to the housing crash question from me. Now, no one has clairvoyance, me included, but I am a 20-plus year active real estate investor that owns properties from Florida to Alaska and beyond, hosts one of America's top real estate shows, and is a columnist for Forbes and other publications. And, you know, some people like to say something like, oh, housing prices, they don't matter to cash flow investors that just want that monthly rental income. And, you know, to that I say, come on now. Price might not be your principal consideration, but price matters. I mean, come on, if it didn't, then the next time that you're buying a property, why not just pay triple the asking price? Why does every classified ad have the price in it? Of course, real estate prices matter, even to cash flow centric investors. It matters when you're buying. The price matters when you're selling, or for you to have an adequate equity cushion so that you can refinance. So let's build some context leading up to the housing price crash question. U.S. home sales dropped last month, and they have for months now. That's nothing new. Okay, that just means sales volume, the number of sales. Affordability is lower since prices and interest rates are higher, and low housing supply is another part of the reason for the volume drop. Available supply is still just half or less of what's needed, and it is going to be a multi-year problem. So then, just before we look at home prices, let's look at housing supply some more. You can't sell what doesn't exist. This paltry supply is an inelastic condition. It's difficult to change. And what's the way out of that undersupplied condition? It is home building. Well, many people believe that home builders are currently in a recession. Some builders are building less while they wait for that affordability to improve. And you know, this is only going to prolong America's housing supply problem. We need at least 1.5 million listed homes to be close to a supply-demand balance on this chart that you're looking at here. And as you can see, we are up off the bottom of the supply, but America is still terribly undersupplied with available homes. We need about 200% more supply just to get things back into balance. So let's discuss prices. Since July of 2019, which was back even before you knew about the great sickness that went around the world, and the only time that you wore masks back then were for Halloween, well, since then, home prices have risen 44.5%. Yeah, 44.5% in just 3 years. Now, if we shorten that up to just year over year median house price growth in America, it is currently 10.8%, still a healthy gain. But that is looking vulnerable. The median sale price from June to July, as I had mentioned earlier, to get that price more exact, it eased from about $413,800 to $404,800. Now, some might say this is hardly a change at all. It's about 2%. I actually think it's meaningful because all we've seen are both year over year and month over month housing price increases for years now. So, well, is this an aberration or is it a trend to come? I think that's something that's worth paying attention to. But what about the crash? Has the time come? Did real estate prices run up too far, too fast, meaning that they must come crashing down to earth in a streaking fireball that's going to leave a smoking, indelible crater? All right, well, let's explore that. The definition of the word crash, you know, that's really somewhat amorphous. A lot of people just throw that term around without attaching any meaning to it. It often means a rapid decline in something, in this case prices. But to help quantify that, if it's equated to a bear market, that means a price decline of 20% or more. Well, that's highly unlikely that a decline like that is imminent. Housing values are famously stable Today's homeowners have oodles of protective equity, near record equity, and their loans are well underwritten. And like I said, that supply is staying low. All right, well, you might be apprised of all of that already, but did you know that even during the astoundingly irresponsible and toxic global financial crisis and mortgage meltdown of 2007 to 2010, that back then, during that cataclysmic event, when it felt like the world was going to end, housing prices fell less than 20% nationally. Yeah, they didn't even crash then, and that could be the first surprise for you here. Oftentimes, I like to follow history. It sure doesn't tell you everything, but history really helps temper your outlook for the future. Use history over hunches, as I like to say. And by the way, how bad was it about 15 years ago then? Oh my gosh, these are the days of liar loans and 105% loan-to-value ratio loans and loose appraisals because appraisers were in cahoots with lenders.
Your monthlies could go up to 300%.
On all my loans?
What do you mean all your loans?
I have 5 houses and a condo.
Hey, there's a bubble.
And we had a glut of national housing supply. Yeah, like more vacant homes than people, the opposite condition of where we are today. There's also a foreclosure crisis layered in there, and nearly every housing market malady that you can think of about 15 years ago, and housing values didn't fall 20% amidst that apocalyptic environment. Yes, what we're talking about here is the median sale price of houses sold in the United States. As you looked at that chart, sourced by the Federal Reserve Economic Data through the U.S. Census and HUD. Hey, I've got more important things to tell you here. Go ahead and put a like on this video if you like being informed on this. And yeah, I guess that's the low cost of admission here. Just leave a like. My goodness, when will I ever respect my effort and ask for more than just a like? Hey, well, according to the NAR, home prices are expected to be up 11% this year and then 2% next year. And Freddie Mac and Fannie Mae and Zillow, they all agree on those same projections. And you know, if you're a longtime viewer here, you're going to recall that near the end of last year, I predicted that this year home prices would rise between 9 and 10%.
Keith, from your analysis and looking at today's data and your analysis up until today, is there any reason to think that house prices, this price appreciation, could slow down over the next 12 months or even decrease in price? Any reason to think that?
I think it's likely that home price appreciation will continue, but the rate of appreciation will slow down. I'm about to reveal my prediction, and then I want to talk to you about what actions that you can take based on my prediction for housing next year. I expect there to be 9 to 10% home price appreciation next year. Yeah, that was GRE's median U.S. home price forecast for this year. And I still think that looks about right. And by the way, that wasn't so easy to do late last year. When I released the forecast, home prices had been up about 20% year over year there at the end of last year, but I anticipated that home prices would cool off. The appreciation rate would cool off due principally to that affordability constraint that we have hit. The major forces that give today's housing market a price foundation against this lowered affordability are these persistently strong jobs numbers and that low supply. And yeah, now you might wonder if the jobs numbers do stay strong and wages are increasing, which they are. I mean, are homeowners going to be able to afford their payments, which support home prices? Are wages increasing fast enough to keep up with inflation? Well, often, yes, homeowners can keep up. That's because inflation, that doesn't touch a homeowner's principal and interest payment at all. That's shielded. Those homeowners are protected. That rate and that payment amount is fixed. That mortgage is typically a homeowner's biggest expense. So if your monthly mortgage is, say, $2,000 per month this year, well, then even after 10% inflation, your salary could be higher, but your principal and interest payment will not be $2,200 next year. It won't be 10% more. It'll still be $2,000 next year and even 10 years from now. And also supporting this market, there is still strong demand today. Homes are still being snapped up quickly despite the lower affordability. There are just fewer bidders on homes for sure. In fact, last month, the NAR tells us that the median home sold in America was just 14 days. That was back in July. It's never been faster than that on record. We're going to get the next month's number soon. And that's probably another surprise for you. And really, that's what a lack of supply makes happen. And we're still going to have a lack of supply in 2023 and 2024. And that's just really not something that you would expect to hear amidst this stalled price growth. Well, higher mortgage rates are going to do that. They're going to stall price growth. Jerome Powell has signaled that he will continue with raising interest rates into the future here. The American housing market reached a turning point now. Price increases have not just slowed, they have stalled. And of course, I've been talking nationally in general here. Local factors often supersede national ones. So then, where are home values least resilient? In areas that were trendy and in higher priced homes. And where are home values most resilient? Generally in lower priced and entry level properties. And then what about these stalled price increases? Who else does that harm? Well, obviously that harms sellers because price matters, remember? And it also harms new owners that hope to refinance fast, and it harms a number of flippers. And what about stalled price increases? Who does that help? Well, clearly that helps buyers, and that helps rent to price ratios. Rents increasing are able to catch up with prices that have stalled. Real estate investors that look to own more rental properties, it's something that they really care about. We really care about that around here with what we talk about at GRE. So the market is positioned so that you're going to get a higher rent income in proportion to a lower purchase price. And this recent outsized rent growth has clearly been a boon to us real estate investors. It's even been a windfall if you're well leveraged. Now, just looking in larger society, in the workplace, the great sickness that beset the world 2 years ago, that spawned what a lot of people called the Great Resignation. People either started working from home or they quit and they stayed at home and they were cycling on their Peloton bike and they were on Zoom. But, by the time we got to this year here, tons of companies from Peloton to Zoom, they've really seen consumers end those buying patterns from the Great Resignation. Well, now housing has as well, along with companies like that. So this sickness era frenzy where buyers hotly demanded more space and a Zoom room and an exercise room and a greenhouse, that's what I have called the great reshuffling. People wanted to get into that right home for them. That's really settled down. So at the point of being overly obvious, compared to just a few months ago, this housing market has become worse for sellers and better for buyers. No house price crash is expected. But sellers, you might have to, say, stage your properties again. You're going to have to try harder. Maybe you're going to have your agent work harder for you. And then buyers, let's run a vibe check on how well you're doing for new purchases. Now, as a buyer, you can usually not have to pay all cash, not offer over asking price, though in some markets you still will. You can have an appraisal contingency there in your buyer contract. You can expect time for a property inspection. This is something that I always recommend for new builds. Get that independent third-party inspection of the property before you buy it. You're often going to have less buyer competition, and you're going to avoid an escalation clause. And it was interesting. A friend just shared something with me. He said, quote, "We are officially back into the 2018 real estate market. I made an offer today on a brand new flip. I got $10K of seller side help and a half page of contingencies." That's what he said. And yeah, that really sums up a lot. The market has normalized somewhat, but it hasn't become totally normal by any stretch with this low supply and this quick loss in affordability that we've had with those mortgage interest rates that spiked fast between early March and early May of this year. But negotiations between buyers and sellers are now more balanced. They are what has really normalized. And there's one group that loves higher mortgage rates. That is single-family rental owners, because those higher rates are exactly what crimps affordability and prices out that first-time home buyer. Well, that makes them rent from you. So that's really the force that's continuing to push up rents at faster increases than historic norms. Fannie Mae expects that home sales will decrease in the next year. Again, that's nothing new. That means the volume of existing home sales. And where exactly does that leave today's first-time home buyer? The person that's really becoming somewhat more of a rare breed. That person that got away and got their own home and didn't have to pay rent to you in your rental property. Well, the NAR, they revealed a profile of today's first-time home buyer, and I think this is particularly interesting. Today's first-time home buyer is 33 years old. That is the oldest on record, the oldest ever. And actually, that might not surprise you since affordability is down, so it takes a new home buyer longer to save and form that capital necessary for a down payment and closing costs and to get everything into shape with their finances so that they can qualify for a loan. Yeah, age 33 now. And this is actually symbolic. The early 30s, they're the most populous age group in America, and these are prime household formation years, and that's what's really driving the demand for housing today. $86,500, that's the household income for today's typical first-time home buyer, and their median purchase price is $252K, so significantly less than today's median priced home of about $400K. They're putting a 7% down payment there on average for the first-time home buyer, so they're often paying PMI each month. Then 37% of them carry student debt, and their typical loan balance is $30,000. And how about the average square footage? The average footage of a first-time homebuyer's new home is 1,640. Well, so this is why a national home price crash is unlikely, the reasons behind it, and a profile of today's first-time homebuyer among this lower affordability market. Hey, grab the free Get Rich Education phone app. That's how you can listen to me break down the real estate market and discuss wealth mindset every week on the Get Rich Education podcast, or just listen to it on your favorite podcatcher. I'm Keith Weinhold. I'll chat with you more over there. See you next time.